All right, welcome everyone. So thanks for those that joined early. Thanks for your patience. Great to see some familiar names here. So yeah, we've got a big session today on credit spreads. Probably going to be mainly geared towards beginners. We'll get into some advanced stuff. So if you're pretty experienced trading credit spreads, you might still pick up a few tips and tricks, but generally we're going to be focusing on beginners. So let me know in the chat what sort of experience level you have with options. But like I said, if you've been trading for more than a year or so, credit spreads, then some of it's probably going to be a little bit basic for you. Like I said, you'll probably pick up a few tips and tricks. But yeah, welcome Timothy, Enrique, Tina. Cool. We've got about 45 people on, which is awesome, all over the world. Daryl's only done the basics of single legs. Mukesh is advanced. So look, hopefully you'll pick up a few tips and tricks. But yeah, if it's too basic for you, feel free to drop off. That's all good, no problem. Welcome to those that just joined. All right, let's get stuck into it. Just a quick reminder that everything discussed today is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So a little bit about me. I first started trading options back in 2004 and made all the rookie mistakes, as a lot of people do when they first start out. So yeah, been doing this a long time. I've been running options trading IQ since 2010. So yeah, can't believe it's been 15 years teaching other people about options now. It's my absolute passion. I love it. I actually have always enjoyed teaching, even in early jobs that I had when I was sort of a teenager. I loved taking on that sort of mentoring role with new staff and sort of showing them the ropes. So I've always loved finance as well. So really, with options trading IQ, I get to combine my two passions of finance, trading, and teaching. So yeah, very blessed to be doing this, and really appreciate you taking time out of your day to sort of listen to what I have to say. Cool. So made all the rookie mistakes. I chased volatile stocks. So some of you may have made that mistake before. Ignored risk. Probably add there, didn't fully understand the Greeks and things like adjustments, trading on instinct, didn't have, formalized trading plans. It was all sort of in my head. And I thought that was okay. And some of you might be in that situation as well. You think, oh, I know what I'm doing. And, it really does make a big difference. I mean, I know it sounds kind of boring and not sexy, but will make a big difference if you have a written down trading plan. Trust me. So that's a few of the mistakes that I made. Hopefully, you can learn from some of my mistakes. Over time, I learned the value of structure and repeatable strategies, and that's why I love credit spreads. So it's a little bit about me. I also write for Investors Business Daily. If you weren't aware, I've been writing for them for about 5 years. I do a daily options column, and same for barchart.com as well. Some of you may have read my articles there. I've been writing for them for 4 or 5 years as well. Hey, Toby, welcome. All right, so things we're going to learn today. We're going to understand how credit spreads work, when to use them based on market direction and volatility conditions. You're going to learn how to build and manage credit spreads and condors using proper strike selection, expiration choice, and risk reward analysis, and spread width as well, I would add there as well. You'll be able to evaluate the impact of time decay, implied volatility, and market movement on the performance of credit spread trades. And you'll evaluate trade setups to identify high probability opportunities and manage risk. So that's what you're going to learn today. So exciting stuff. I imagine we'll go about an hour or so, depending on how many questions there are. But yes, that is the plan. So what is a credit spread? Well, first and foremost, we sell an option and then we buy one further out of the money. So it's basically just a two-leg option strategy. We sell an option and then we sell one further out of the money. It generates a net credit, and which is what we call premium. So there's two main types. There's a bull put spread and a bear call spread. And then, of course, we can combine the two and it becomes an iron condor. Iron condor is basically just a combination of two credit spreads. So credit spreads can profit in the following ways. Favorable movement in the stock price. So that's our delta. That's probably the main driver of the trade. Now, if we do a bull put spread, a bullish trade, it's what I would call a slightly bullish trade. It's not an aggressively bullish trade like a long call option or even a bull call spread, or even something like a poor man's covered call. But delta is still going to be the main driver of the trade. So we want to get our direction right. Now, we can still profit if the stock doesn't move in our direction. So small unfavorable movements in the stock price can still be profitable, depending on how far out of the money we place our strikes, how far the stock has moved, and in what sort of time frame it moves. We profit from time decay, so that's what it's all about. Most option selling strategies are looking for that time decay. And they can also profit from a decrease in implied volatility. Again, delta is the main driver, but volatility also has an impact as well. So, for example, if we put on a credit spread over a few days, the price stays flat, but volatility drops, we're going to see some profits generated from that, or the price of the spread will decrease. We'll be able to buy it back for a lower price, resulting in a profit. So that's how we can profit with credit spreads. That's why I love them as well, because we don't necessarily have to be right on the direction of the stock. Whereas if we buy out of the money call options, we've got to be right on the direction. We've also got to be spot on with our timing as well, because time decay is working against us. Whereas in this case, time decay is working for us. So when do we use credit spreads? We use a bull put spread if we have a neutral to bullish market. So again, they're a slightly bullish trade. They're not an aggressively bullish trade, perfect in a neutral to bullish market. We use bear call spreads in a neutral to bearish market. They're ideal to use when during consolidation or when volatility is elevated. So again, delta is our main driver of the trade, but volatility is our secondary driver. If we put our credit spreads on when volatility is really high, volatility comes back down. That's really good for our credit spreads. So put credit spreads, bull put spreads, a vertical spread, sometimes they're called. They're a fantastic strategy because stocks tend to rise over time. This is a strategy that you'd implement if you were bullish on a stock or felt that it wouldn't decline by too much during the trade. Yes, it is being recorded. I just had to double check. And I will send the recording out. A put credit spread is known as a bull put spread and is constructed by selling a put option. Now, generally, that's going to be out of the money, and we'll get to strike selection in a minute, whether that's 15 delta, 25 delta, 35 delta, whatever. But we sell a put option, like I said, usually out of the money. Then we buy another put option at a lower strike price in the same expiry period. Pretty simple. Most people trade bull put spreads as out of the money spreads, which gives them a good margin for error on the trade. The further out of the money the trade is placed, the less premium that's received and the higher the capital at risk in the trade. So I like to say everything with options is a trade-off. If we go with a really low delta, really far out of the money, we've got a really big margin for error. The stock can have a really big drop and we're still going to be okay, but we get only a little bit of premium. Whereas if we go more aggressive and we're trading a higher delta closer to the stock price, we get a higher premium, but we've got more chance that the stock might drop through that short strike. One regular trade I like to do is a long-term bull put spread, bull put credit spread on blue chip stocks that have become oversold. So I'll show you one little scanner that I use, which is really handy. So let's go on. Before we do that, I'm going to show you a couple of scanners that I use. This is what I'm talking about. So if you go to stock charts, you can get what's called a candle glance of the Dow stocks. And I've got a 2-month chart and I'm sorting by RSI. I'm just going to grab this link and I'll pop it in the webinar chat so you can open that up. Hopefully some of you might have 2 screens or whatever. You can open that up on another screen. So basically we get to this candle glance area and under predefined groups here, we go to our Dow stocks. Now these are the 30 of the most liquid stocks in the market. Some of them are less liquid, like Honeywell, Sherwin-Williams are probably not 2 that I would really trade that often, but Nike, Disney, very liquid stocks, Amazon, quality blue chip companies. And when they decline, they tend to bounce back because they've generally got good earnings. Maybe they're just going through a bad period, but they generally bounce back. I'm just trying to think of what an example was. What was CRM? CRM was the most oversold stock in the Dow back in mid-August, and it's had a pretty decent rally since then. A little bit of a bad day today, but it's bounced off the lows. So that's the type of setup that I would look for when a stock gets really oversold, one of these blue chip stocks. I'll sell a long-term out of the money bull put spread. IBM was the other one around the same time. And now IBM's now one of the most overbought in the Dow. You can see here back in mid-August. I apologize if it's a little bit small. Let me try and zoom in a bit here. Where's IBM? Here. Back here in mid-August, it was along with CRM, along with UNH, it was the most oversold stocks in the Dow. All of those have now had a really nice recovery. So that's one way to find a good trade idea. And I'll show you how to set these up, these long-term trades. Let me just get there we go. So feel free to check out that link. The other thing you can do here, once you come to this link, you can, for some reason, they let you have all 30 of the Dow stocks. This is a free resource, by the way. You don't have to have an account. When you're looking at individual stocks, you can have up to 12. And you can just type them in like this with a comma, up to 12, and then hit enter or go, and you can get a candle glance of your most favorite stocks. Okay, so I'll have a couple of tabs up with bunches of 12 stocks, and that's a way to sort of monitor some of the favorite stocks that aren't necessarily in the Dow. If there's one of interest, we're going to look at Amazon today. I had a really big bearish candle today. From there, what I'll do is I'll come in and drill into the chart in a little bit more detail. Now we can see it broke through some of the key moving averages, very bearish candle today. And another indicator so let me go back a step. If we look at the settings, you might want to take a screenshot of this. I've just got simple moving average. I've got the 50, the 200, and the 21-day moving average. I've got RSI above the stock chart. I've got this indicator here, accumulation distribution. Excuse me. This is a really important indicator that I use. Money flow index, I wouldn't worry too much about this one. You don't really need to use that one, but this one here is really important. Now, I like to say that price action is the main concern. So that's our candlesticks. Are we putting in higher lows and higher highs? Or are we putting lower highs and lower lows? What are the candlesticks? Are we putting bearish candlesticks, bullish candlesticks? What sort of chart patterns are we getting? That's the number one thing. Then our moving averages are important as well. Are we trading above or below the moving averages? Are they trending up or down? And then this secondary indicator, accumulation distribution, this basically tells us, are people buying or accumulating the stock? Or, beneath the surface, are they selling or distributing the stock? And we can see here, in the last month or so, this line's trending down quite badly. So a lot of people are selling Amazon. So that's a very bearish breakdown today. So we might look at a bear call spread on Amazon as an example. Whereas, how do I get out of this? There we go. We'll try and find a bullish example as well, and I'll show you some other screeners. And we'll look at some bullish examples first. But technical analysis, this is the kind of thing that I'm looking for, these bearish breakdowns with a lot of distribution. Whereas, let's just try and find a bullish example. Robinhood has been a very strong trend, and it's still showing very strong accumulation. Since April, that line's just been trending up really solidly. So a lot of strength in that rally. So that would be a good candidate for a bull put spread potentially. A couple of other scanners I use. These are paid. It's probably the only paid product I recommend, which is Bar Chart. They have some amazing stock screeners, amazing features as well. Obviously, I work with them and have actually helped them develop a lot of their option functionality. If we go here to Microsoft, I've worked pretty closely with them on some of these volatility charts and gamma exposure, max pain, things like that. So really great company. Can't recommend them highly enough. I think it's maybe $19.95 a month. But I've got some of these stock scanners. This is, if you've got Bar Chart, you might want to take a screenshot here of how I use this. Just basically looking for stocks with really good volume, high market cap, and I've got, is it making a new 20-day moving average signal? Basically, if it's a buy, it's crossing above the 20-day moving average. If it's a sell, it's crossing below. Then I'll sort by call volume. So I'll get the most liquid stocks at the top here. And again, if we're getting a buy signal over here, it's crossing above the 20-day moving average. If we're getting a sell signal, it's crossing below. We had a little bit of a bearish day today, so there's quite a few sells. Trying to find a bullish example, but MSTR was another one that jumped out at me from a bearish perspective. We go and look at the chart. It's below all the moving averages here. It's below the 21, the 50, and the 200. Those lines are generally trending lower. We're seeing a fair bit of distribution. That line's pretty weak. Bearish candle today. Oh my gosh, what's going on with my voice today? The other thing that I find in a bearish trend, and we get the opposite in a bullish trend, is on any counter trend rallies, the stock struggles to get above 50 RSI, sort of 50 to 60. So that's a really good bearish setup. Whereas when it's in a bullish trend, RSI 40 to 50 tends to hold as support. So that's a really good bearish candidate as well that we might look at. Question you, Kevin. Are you always trading with the market, i.e. Amazon trending down on a strong stock? Is the current position not a setup for a lucrative bull put spread? Yes. So I do like long-term bull put spreads on quality companies when they drop. If I'm going to do a short-term sort of trade, I'd probably be a little bit more bearish on Amazon right now. But from a long-term perspective, yes, I would be looking to, I'd maybe give it a little bit longer, let it decline a little bit more, and then I'd be looking at maybe a long-term bull put spread, absolutely. But for now, that bearish candle crossing below the moving averages and a lot of distribution, I just think there's going to be some short-term weakness in Amazon potentially. So I have that for the 20-day moving average. I have it for the 50-day moving average as well, and the 200-day moving average. So that's how I sort of find some trade ideas. Yeah, good question. When I say long-term, so for me, long-term is 90 days plus, or 60 days plus. That's what I would call a long-term trade. I don't do any short-term trading. I don't do any zero-day trading, anything like that. Can you clarify the differences between bull put spread, bear put spread? Yes, we'll do that for sure. Another one I look at here is some bullish and bearish engulfing candles. So again, this could be a nice one to see any bullish or bearish breakdowns. I need to add like this was bearish engulfing candles. So again, Tesla, then I'll come in here and look at this. And is Tesla sort of breaking down? Is it hitting resistance? Probably not. It's a very strong stock, so I probably wouldn't be betting against it, but maybe it's hitting a bit of resistance here. It's pretty overbought. And then the other one is bullish engulfing candles. I don't worry about too many of the other ones. So, some of the healthcare names popping up today with some bullish engulfing candles. Things like that. Any questions on sort of finding trade ideas? So again, we sort of started out looking at our long-term put spreads on our blue chip companies. Now, Nike and Disney have struggled a little bit in the last few years. They're possibly not the best example, but I'm going to show you what I might do on a stock like Nike. Might actually use Disney because I think Nike's got earnings coming up very soon. So the first thing I do, just wondering if I need to turn the video off so that you can see a little bit better, but let me know if that's a problem. This is Interactive Brokers Risk Navigator. So the first thing I always do is come in and I analyze the trade before entering it. So let's say Disney. I type in the ticker, I go to options. Now, for me, a long-term trade, again, is about sort of 3 months. We've got 86 days to expiration. Normally, I look around a 15 delta, but we don't have a 15 delta in this case. So let's look at a 19 delta and 5 points wide or $5 wide. And I usually use 2 contracts for my examples. And let me just set this up. If you're using Risk Navigator, you'll be able to follow these steps. If you're using a different broker, most brokers have something similar. Think or Swim has the Analyze tab where you can sort of do something similar. I think even Tastyworks has something a little bit similar. But basically, I want to look at the trade. I want to see how much premium I'm receiving. So this is our premium here. Max profit of $150. That's how much premium we'll receive, and I'll walk you through the numbers in a second. We've got 2 contracts, $5 wide, so that's 1,000 of risk, less the 150. So there's our risk 850. So let me just walk you through those numbers in terms of how we get to that premium received. So we sell 2 of these $100 puts. So we receive positive cash flow for that. And we buy 2 of these ones. So that's negative cash flow. And I'll just put in, whatever the prices are. A credit of about $153 for those 2 contracts. If I was to do one contract, which maybe that would be easier. We would receive 197 and we'd pay 120. We get about $77 per spread. You can see that on the risk graph. 500 minus the 77 is our maximum risk. So that's our premium or max gain. This is our capital at risk or our max loss. Okay, everyone following so far? So now we've got a return potential of about 18% in about 3 months. So that's the sort of trade that I will look at. Now we've got quite a decent margin for error as well. Disney can drop all the way to 100 before our spreads go in the money. Now adjusting is another story altogether. I could probably do a whole hour just on adjusting. We'll get to that later today. In terms of trade management, because getting into the trade, I always like to say getting into the trade is the easy part. What comes next is hard, is the trade management. But that's our return potential. If we go back and look at the chart of Disney, we want to do a couple of things with our strike selection. We want to base it on delta or probability. We were trading roughly a 19 delta on that short strike. That has a roughly 81% chance of expiring worthless. And we can see our strikes all the way down here at 100. Let me just sort of mark that on the chart. There's our short strike all the way down there. There's our spread, 195. So quite far down. We've got a lot of margin for error. Yes, we'll get to trade management shortly. Enrique says, when I've tried spreads before, I've been assigned the shares. Is this a setup to avoid being assigned? Yeah, we'll get to that in trade management for sure. You definitely want to avoid being assigned. I'll show you how to do that. But that'll come later today. So that's a pretty standard type of trade for me on a quality blue chip company, 3 months to expiration, preferably around a 15 delta, but 19 is okay. Yeah, I will get to trade management shortly, but let's move on. So that's a standard bull put spread. Any other questions on that other than sort of the trade management stuff? How many days do I wait for the trade? I have a profit taking rule. If 50% of the profit potential has been achieved in less than 50% of the time or the duration of the trade, I'll close it early. So that's my main profit taking rule. All right. Let me show you how to do the trade entry. Again, this is going to be slightly different depending on what broker you use, but with Interactive Brokers, you type the ticker in here. You go to option combinations, option combos. Now you can do this on your phone as well. I've got a YouTube video that I did a week or 2 ago on how to do this on your phone, which might be easier. We want to make sure we're on vertical spread, which it is sort of defaulted to that already anyway. We'll choose our expiration date. We're doing puts. This is where with IB it gets a little tricky, and it's one of my big frustrations with IB. We kind of have to do it backwards. So we want to sell the 100 strike and buy the 95 strike, but we actually have to set it up backwards, which is really annoying. So we set it up as that. It's basically setting up a generic put spread. And then what we do is we sell that spread. We do get this little cheat sheet here. We want to sell the bear spread, which means selling the 100 strike, buying the 95 strike. We always want to just check this, make sure we're selling the one that's closer in. Is your profit taking rule based on the assumption that you have alternative new trades to use the capital? Yes, exactly. So if I've made 50% of the profit in 2 weeks, for example, say Disney bounces and rallies up, there's no point waiting another 2.5 months for that last, 50%. You can reallocate the capital exactly as you said. So it's after hours here, so we're not getting a bid-ask spread price on the actual spread. But we can see here that this option's trading about $2. This one's trading about 120. The difference is about 80 cents. So we know the midpoint is about 80. And that sort of matches with what we said about 77, right? So we want to come in here. We want to click sell. We'll just keep it at the one contract. And we want to sell that for, say, 80 cents. All right. And we'll set that as a good till cancelled order. Hit transmit. That goes live. Now, we're after hours at the moment. I'll do all my analysis after hours and I'll set up all my trades like this. And then when the market opens, I can come in and, make sure they all get filled. Now, what I actually do is I won't start the order at 80 cents. I'll put it in at, say, $1, just in case Disney opens lower, whatever. Maybe I don't want to get filled at a bad price. So this is what I call sort of a resting order. Now, I could put it at $1. Doesn't really matter. I could put it at $3. As long as it doesn't get filled, but the order's live in the market. Then when the market opens, if the midpoint of the spread's still around 80 cents, I'll come in here really quickly, and I do this on my phone a lot, so I don't have to actually get up in the middle of the night for us Aussies. I'll just do it on my phone. I'll come in, I'll update the price to the midpoint, then I'll get it filled. Robert says, what's your philosophy that this example provides a small gain to the potential loss? My experience is one bad trade wipes out many small victories. Depends how you're trading them and how you're managing them. So that's really the key with credit spreads. Less active trader. Do you not have an who does not have an alternative use of capital? You might be okay with deferring the profit taking. Yeah, potentially you could hold a little bit longer for sure. But again, if it's decayed to say 10 cents, there's no point holding for that last $10 of profit if you've got to hold it for another month or two, right? So it's all sort of relative. How do you manage the equity or number of trades? Position size, you want to be no more than 5% on each position, 5% of your account. So that's, if we go back here, we're risking 425. You want to make sure that 425 is not more than 5% of your capital. So let's say you have an account size of 20,000 and we're risking 425 roughly. That's about a 2% position size. So that's totally fine. It's under 5%. We could potentially go with 2 contracts. This would be whatever, 800 would still be under the 5%. So that's how you do that. In terms of number of trades, as a beginner, I would recommend no more than about 10 trades at once because they can become hard to manage and keep on top of things once you get above 10. Even when you're starting out, 5 or 6 to start with at one time is a good idea as well. So again, if you've got a $20,000 account, you've got 5 of these small trades, you're only risking $2,000 in total out of your 20,000. So you're not going to blow up your account if you keep to those sort of rules. And then once you get more experience, you can start building more positions and things like that. All right, so that's our trade entry. Any questions? Any other questions? Great questions so far. Capital allocation, your 5%. For primary capital, not the possible needs of capital for secondary exit follow-up trades. Yes, that's true. So sometimes we do add to trades and do adjustments and things like that. So, here we're going with a 2% position size. So that leaves us capacity to add to the trade if we need to. We could double the position size and would still be below that 5%. So yes, we want to keep some capital aside for things like adjustments. A good rule of thumb is to keep about 30% of your capital in cash for adjustments. How much is the profit and stop for each position? So profit taking, again, 50% profit. So if we sell that for 80, what we can actually do, let's assume the market's open, we've got filled at 80, that order, we've sold that bull put spread, we can come in straight away and do a profit taking order at 40 cents. And we can just leave that sitting there. Hopefully Disney rallies a little bit, we get some time decay, and that just gets taken out as a profit take. If not, a good rule of thumb for a stop loss is 1 to 1.5 times the premium received. We don't want to lose, if we're generating 80, we don't want to lose more than about $80. So that's a good stop loss level, even up to sort of 120. But again, above that, we don't want to lose more than that, right? And I think someone mentioned that earlier. Robert, having one bad trade wiping out all the winners. So that's why you want to make sure the loss doesn't get too big to get too out of control. So that comes into trade management, which we'll cover. All right, so that's bull put spreads. Let's look at another example. So assuming we're bullish on the S&P 500 over the next month, we could sell a put credit spread on SPY. Typically, this would be below the market. My preferred setup is using 15 delta as a short strike. Sort of covered that already. Let's take a look. So we've looked at Disney. We can just do a generic SPY put spread as well. So let's look at another example. Again, I tend to go with slightly longer term trades. That's just me. A standard would be sort of using the monthly. 23 days to expiration is a little bit low. Standard would be sort of 30 to 45 days is a really good sweet spot, but we'll stick with 23 days here. We'll go find our 15 delta. And I like to keep to SPY is super liquid anyway. It doesn't really matter, but I'll stick with this one because it's 635. It's just a nice round number. Well, not a round number, but it's $5 wide is always quite easy to trade. Lots of open interest. You can see here, 34,000, 92,000. We'll do just the one contract again. The October expiration. Now this one's only generating a bit under $50. So it's not as good. We want to try and get a bit more than that. Again, when we go and set up our order, we can put that order in to sell it at 50 cents or 55 cents, see if it can get filled at a slightly better price than what this is showing. So I'll just show you one more time how to do that order entry. Again, different with every broker, but this is how you do it with IB. The general process is going to be pretty similar, depending on what broker you use. This time we're on vertical spread already. This time we're using the main October expiration. We're doing puts. The closer in strike, the one that we're actually going to sell, was the 635. Again, remember we have to set it up backwards at IB. Again, we get our cheat sheet. We want to do this. We want to make sure we're selling the bear spread, selling the one that's closer in. The midpoint of the spread at the moment is only about 43 cents. I want to try and get at least 50 cents. So I'd put my order in for 50 cents. I'd leave that sitting there. Maybe it gets filled, maybe it doesn't. If it doesn't get filled, I just cancel the order. I move on to the next opportunity. But that's a pretty nice, easy way to test out a trade as well. You're only risking $450 or so. Pick SPY or pick a stock that you're really bullish on. Even if things go really badly, the most you can lose is $400. Hopefully that's not going to break the bank for anyone. Obviously it's, not great to lose $400 and you want to manage the trade. You want to stick to that stop loss, but, it's a good little way if you've never traded before to do a little test trade. Do I ever hedge your position by buying puts? If so, what do you buy them? I do hedge. Sometimes I'll buy puts. What I do is I manage the portfolio overall. Again, that's another huge topic. But I'll have a mixture of bullish and bearish trades and try to sort of manage my market exposure that way as well. So I'll have some bull put spreads. I'll have some bear call spreads. Obviously, if the market drops, that's going to be bad for the bull put spreads, but it's going to be good for the bear call spreads. So that's how I sort of manage that. You don't want to necessarily go in with all bullish positions, particularly at the moment. The market's had a bit of a down day today, looking like there's a little bit of weakness. We're coming into a weak time of year. You wouldn't necessarily want to go with all bull put spreads. You want to have a couple of bear call spreads and some other bearish trades. I don't really use XSP, but you can use that. It's no problem. Do I always use a stop loss? Stop loss orders, automated stop losses don't really work with options because of the bid-ask spread. Profit-taking orders do work. Stop losses don't really work. I guess we can talk about that. There's been a few questions on trade management. Let's go back to our Disney example. So what I do, once my trade is entered and filled, I set a decision point or a price alert. So we're trading at about 112. Our short strike is at 100. I go to the halfway point and that's going to be my decision point. So 106. If Disney hits 106, I've got a decision to make. I have to either hedge, adjust, or close. So that's why I call it a decision point, an alert point. And that's going to stop. I know someone earlier mentioned getting assigned. If I adjust here, I'm never letting the stock get below my short strike at 100. So I'm never going to have assignment risk unless, there's some negative news item or whatever and Disney gaps down to 95. Like that can happen, but quite rarely. But if Disney slowly grinds down, hits 106, I'm going to adjust the trade. All right. So that's how I manage it in terms of the stop loss. I don't actually have an automated stop loss. I'm going to have a price alert that's going to tell me if there's a problem with the trade. Then I'll go in and I'll decide adjust, hedge, or close. So to set a price alert, again, different with every broker, but for IB, I right-click on the stock ticker. I hit this little bell icon. Apologies if it's a little small and hard to see, but I'm going to say here, if it drops below 106, I'm going to get an alert. And click this button here, which is advanced settings. Don't need to worry about this. I just go next, finish, alert active until the expiration date of the option, which was December 19, and activate. So now I've entered my trade. We're going to assume the market's open. I've sold that spread for 75, 77, 80 cents, whatever. I've got my profit taking order in. I've got my price alert. I can basically just leave that trade alone. As long as my price alert doesn't go off, I know the trade's going to be more or less okay. If it's down at 107, I might be down $20, $30. It's not the end of the world. There's no issues. So that's another way, particularly for Aussies or people who are busy working full time, can't be in front of a screen all day watching these trades. You set your price alerts, and then you basically don't need to look at the trade unless that price alert goes off. You have a minimum risk reward. Yes, 10% minimum for this sort of trade with a sort of 15 delta. So you want a minimum 10% return to reward. Yeah, IB can be a little bit of a headache, Aaron. I sort of agree. I remember when I first opened my account with IB, it was so overwhelming. And most people have the same. You've got all these tools and things up here. Honestly, I don't use hardly any of them. You can basically ignore this. Everything I've shown you now is pretty much everything you need to know. Risk Navigator, again, you might need a little bit of practice with that. You've got your spread order entry, you've got your alerts. That's all you need. All right, so that's a little bit on trade management. Again, I won't go too deep into adjustments today because it would probably take a whole hour just on adjustments, but that's the first step, is setting that decision point. Don't ever let the stock get down here to 100, 101. And that's a real beginner mistake that I see a lot of people making. Disney will be dropping. It'll get down to here to 101, and people will say to themselves, oh, my spread's still out of the money. As long as it stays at 101, it's going to be okay. It's going to expire worthless. Disney keeps dropping. Now it's down here at 97, 96. And now you do have assignment risk. You could get assigned because that short put is in the money. So don't do that. Set your alert point at the halfway mark. Return per year, it depends. Really depends on how good you are with your stock picking and trade adjustments. IB can set an exit by mentioning a dollar amount or percentage return. Is a stop loss a dollar amount or price level? So the decision point is the price level, and then the stop loss. Usually if your decision point hasn't gone off, you're going to be totally fine. Like I said, we're generating about $80 here. If it hits 106, we're only down about 50, and our stop loss was kind of 80 to 120. So the decision point is going to kick in well before the stop loss. My alert is based on the price bell, but it's a little tricky, but you can set a price alert on Delta as well if you like. I think you come in here, you right click on the strike and you go set alarm, and you say if the delta gets above 30 or whatever, you'll get an alert that way as well. So you can do that. I generally don't bother with that because my price alert kind of covers that anyway. Yes, the price alert is the midpoint between the stock price and the strike price. I usually just eyeball it. You can kind of calculate it if you want, but pretty easy. 100 to 112, halfway point's 106. All right, so that's bull put spreads. Bear call spreads, basically the opposite of put spreads, and they're implemented by traders who think a stock will decline or not rise by too much during the course of the trade. A call credit spread is known as bear call spread and is constructed by, you guessed it, selling a call option out of the money, 15 delta, whatever delta you choose, and then buying another call option at a higher strike price in the same expiry period. Yeah, 15 to 20 delta. Exactly. Thanks, Aaron. Yep. Now, before we get to condors, let's look at a bear call spread. Now, we sort of saw Amazon earlier was a little bit bearish, had a lot of distribution, had a lot of a big bearish candle today. Now, again, longer term, I'm more bullish on Amazon. Great company. I want to do bull put spreads, but I want it to decline a little bit more first. I think in the short term, it looks kind of bearish. So I'll go with a shorter term expiration this time. I'll scroll to my, we don't have a 15 delta. We've got either a 13.5 or a 16 delta. I'll go with the 16 delta. I'm going to have some possible issues here. Sometimes IB, again, another issue with IB, they don't populate the data and then it's going to give me a problem when I go to Risk Navigator. Sometimes if you just go to a different expiration and sort of scroll down and then come back, sometimes it populates. Yeah, there we go. So now I've got the delta and the information here. Just a little tip for you with IB. It's one of those little bugs. They literally haven't updated this software in about 15 years. So there's a few little buggy things like that. So this time we're going to sell the one that's closer in. Basically the opposite of the bull put spread. Let's do our little cash flow. We're going to receive $147 for selling this one. And we're going to pay around $95 for buying that one. That's our premium or our max gain. And our max loss is 500 minus the premium. Return potential about 11%. So a bit lower in this case. Still above our 10% threshold though. Yeah, you can use the expected move as well. Expected move and delta kind of go hand in hand. Yes, you can specify a dollar amount to exit the spread in IB. I kind of showed you that with the profit taking where we set the buy price at 40 cents. All right, so where's our alert point going to be in this case? Now we could calculate it, the difference between 221.5 and 245, divide that by 2. What's that, 24? About 12. So it's going to be about 232. Or we could just eyeball it. I'm going to say probably 2. Maybe I calculated that wrong. 231 seems more like the midpoint. Yeah, just eyeball it. Now, notice here on this T+0 line, there seems to be a delta issue here. Sometimes, again, another little issue with IB, I tell you, they really need to fix some of this stuff. Sometimes you have to reset the T+0 line. This should always be around 0, right at the current stock price. So price of 231, we're going to be down about 75. So again, only about 1.5 times the premium received. So that's, again, a good spot for our alert point. And that's if that happens tomorrow. If that happens, in a couple of weeks' time, that was a T+0 line. If we change that purple line, where are we? 24th. If we change it to October the 8th, that's a T+14. Trade date plus 14 days. If in 14 days it hits 231, we're only down about $25. So again, you can see that alert point. As long as we're taking some action when it gets to this point here, we're never going to suffer that massive loss, right? Yes, you can use IV rank as well for strategies. Obviously, having a high IV rank is good for credit spread trades. All right, so we've got our setup. October 240 call. Maybe it's time to switch to Tasty. Yeah, Tasty doesn't They don't have anything like Risk Navigator, in my opinion, and they're not great for complex trades. They're okay for simple trades, but for complex trades, they're not the best. But their commissions are good. So yeah, look, Tasty is a good broker, but I've been using IB for so long, I'm kind of used to it. All right, so now we do the opposite. We come in here, Amazon, combinations, option combos. We're still on vertical spreads. We're doing October expiration. We're trading calls this time. Oh, I've forgotten the number. Was it 240? Anyone remember? What was my strike? 240 and 245, I think, right? Hopefully I got that right. Add and okay. Let me just double check. Yeah, 240. Okay, good. So we've got our little cheat sheet pops up again. Now remember, we want to sell the spread. We always want to sell the one that's closer in. In this case, that's this 240 strike. Again, we know that's trading about 50 cents. We put our sell order in. I'm going to set that up with a resting order. I might put it in at $1.50, so I know it's not going to get filled. When the market opens, I'll see where the spread's trading. I'll drop it down towards the midpoint and wait till that gets filled. Once it gets filled, let's assume that's got filled at 55. I'll do my buy order. Maybe I'll buy it back at 20 cents. Good till cancelled. There's my profit taking order. And then my alert is the last point. Create alert. If it goes above 231, advanced settings, next, finish, active until the expiration of the trade. And bang, I'm done. Like a couple of minutes. Like you really get the hang of it once you've done it a few times. But I get that when you're a beginner, I sometimes forget I've been doing this for 21 years. When you're a beginner, this can be a bit overwhelming. You might want to take your time a little bit more. But yeah, once you get the hang of it and you've done it a few times, it gets pretty quick and easy. Complex strategies, some of the more multi-leg stuff, condors, trapdoors, things like that, butterflies, broken wing butterflies, ratio spreads. Do I wait to expiration or take profit at 50%? If the 50% profit has been achieved in less than 50% of the time, I take the profit. Now, another rule is I generally want to start to close out once we get down to around 7 to 10 days to expiration, no matter what, because that's when big losses can occur if the trade starts to move against you late in the trade. I've sort of covered the alerts. Maybe you missed that earlier. Those are our price alerts or decision points. Bell says, why is the short put at 19 and the calls at 16? We didn't have a 15 delta on Disney, so I had to choose between a 19 or an 11. So I chose the 19. Generally, I want to be around that 15 delta, but I didn't have a 15 delta on Disney. Amazon, I didn't have a 15 delta either. 16 was kind of the closest. Yeah, I mean, if you're comfortable with Tasty, that's totally fine. I think they're better for commissions as well. You don't pay commissions on closing trades, right? Which is really good. All right, so there's our bull put spreads, our bear call spreads. Bell says, isn't the usual recommendation to sell 30 delta, why 15? You can choose any delta you like. I like a 15 delta. My price alerts work. That's just how I've been trading them for a long time. So that's just my process. If you want to use 30 delta, totally fine. Let's look at another example. Let's go Robinhood looked pretty bullish, right? So let's look at a 30 delta compared to a 15 delta. Let's see if hopefully we've got a 30 delta. All right, so we'll use that one, 29.6, roughly 30 delta. We'll go $5 wide. Oh, we haven't got the data there. Let me just click off the tab. Back. See, that's what happens because I've added it already. Honestly, the more I think about it, the more frustrated I am with IP. Let's go with the 31 delta. And this one is to be 5 points wide. So we were using these ones now. Okay, so we sell the closer in one. We're selling that roughly 30 delta. And we're buying that one. Now we can see a much different risk reward ratio here. We're getting about 150 in this case and 350 of risk. So We're generating 418 for selling the closer in one. We're paying about 271. We're getting about 147, 350 risk. Now we're getting a 41% return potential. So that's great, right? Much higher return potential. The trade-off, remember I said everything with options is a trade-off. Our short strike is a lot closer. You know, if we were to set a price alert at the halfway point, it's going to be about 122.5. That's really close to the current stock price. So this trade could come under pressure really, really quickly and need to be adjusted very quickly. But if you're very bullish, this trade's going to do better. If the stock rallies, it's going to be great. It's just going to need, there's more chance because this is a higher delta. There's a higher probability that the stock's going to get down to that level. There's a 69% chance it's going to hit that level. So that's the difference. Everything's a trade-off. Whereas if you do a 15 delta trade, there's our 15 delta, 109, $5 wide would be 104. Buy that one, sell that one. We're generating less premium. We're now only getting, you know, that $70 in premium, but our strikes are way further away. So that's the trade-off. Yeah, I covered how to calculate the decision points. Do I have a service? I have a couple of programs. I have Options Income Mastery, which is kind of more for beginners. That's a 1-month program. We go through about 7 strategies and we follow the trades along for a month, including all the adjustments. Then I have an accelerator program, which is a 12-month program, a little bit more advanced, a couple of extra strategies, weekly webinar, and following all these trades. We do sort of 7 to 10 trades every week, and we follow them along, including all adjustments, things like that. Yeah, Aaron, sounds like you've got to set those decision points and avoid assignment. Don't let the stock get down near your short strike. Adjust or close when that just, you know, the halfway point gets hit, and that'll stop that that risk of assignment happening. So that's the difference between a 30 delta and a 15 delta. Now our midpoint's about 117. Much further. The stock can have a much bigger drop before we need to adjust or before our alert points hit. All right, so when you combine a put spread and a credit spread, you get a position known as an iron condor. It's a direction neutral trade and will profit if the stock remains between the two spreads during the course of the trade. Iron condors generate 2 lots of premium, so we can double our return potential. The capital at risk also decreases. This is due to the extra premium received while the spreads are the same distance apart. The stock can only move one way as well. So that's kind of why. We'll see it in a second. Let's take a look. All right, let's use Robinhood as our example. So here, let's go back to our spreadsheet. Let's clean this up a bit. Here we're getting 171 minus 106, getting about 65 in premium, capital at risk 435, about a 15% return potential. Perfect sort of trade setup for me. Again, other people might want a 30 delta, totally fine. Now, if we were more neutral and we wanted to do the bear call spread as well, again, we'll keep the delta about the same, about a 15 delta, all the way up here at 150, $5 wide, and we'll do the 1 contract. Now, we've actually decreased our capital at risk. We're getting a second lot of premium, but we're not adding any risk to the trade. So now we're getting another 139 minus 97. Now we've got $107 in premium, and that sort of ties in with our risk graph. And our risk has dropped to 393, and our return's gone up to 27%. So condors are great because we generate extra premium, particularly if you think the stock's going to be fairly flat. Again, volatility has an impact, IV rank, all that sort of stuff, but delta is going to be the main driver of the trade. You want a stock that's going to be flat. We set our alert points the same way, halfway on the downside, about 117, halfway point on the upside, about 137. As long as those alert points don't get hit, the trade's more or less fine. If they do get hit, that's when you go into trade management. Closing out is the easiest, just close out. But You can do adjustments, delta hedging, all that sort of stuff. Again, I could probably do a whole hour on adjustments. Yes, there's a replay. What rules should be followed regarding delta? Again, the delta is all about probability. 15 delta has a roughly 15% chance of being expiring in the money, a roughly 85% chance of expiring worthless. So it's all a trade-off. Do you want a high probability trade with a low probability that it's going to get assigned? Or do you want a lower probability trade but higher premium? Yeah, IV is a factor as well. For condors, typically you want high volatility because we're negative vega. So we're going to benefit if volatility drops. But again, volatility is kind of secondary. Delta is always going to be the main driver of the trade. Website's optionstradingiq.com. Dennis, cool. All right, so buying condor, pretty simple. We learned how to do a bull put spread. We learned how to do a bear call spread. A condor is just a combination of the two. Now you can do that as one order entry, or you can do it as two separate spreads. I usually do them as two separate spreads. It's a little bit easier, particularly in IB, again, because of the backwards thing. It can be a little bit tricky with condors. All right, so we've kind of talked about short-term and long-term, but let's discuss that in a little bit more detail. Short-term credit spreads can be excellent for generating income, but they're not without risks. Before we look at the risks, let's talk about the positives. The main reason for trading weekly or short-term credit spreads is they provide huge amounts of time decay, so profits can be generated very quickly. So you're getting a huge annualized return. The trade-off, again, there's that word, trade-off, everything's a trade-off, is that you have very high gamma risk. Now, don't worry too much about what gamma is. It's basically just your price risk. If you have high gamma and the price moves against your position, you're going to suffer losses really quickly. Beginner traders get very excited by the profit potential and fail to realize or fully understand the risk. There are many websites and gurus out there claiming it's super easy to make 5% per week. And yes, you can when the trade goes well, but the trouble is when it goes against you. Now, everyone with a basic understanding of finance understand that high return equals high risk. Again, that trade-off, high return, high risk. Therefore, if someone's claiming to make 5% per week, which equates to 260% per year, do you think there is much risk involved? What do you think? Do you think 260% returns per year are easily achievable? So don't get sucked in by the marketing. For me, a good return is 12 to 18% per year. Okay. I do fairly low risk stuff. You can generate higher returns. I have guys in my group who've been doing 60% per year, but they're taking more risk and they have bigger drawdowns when the trades go against them. Okay. So I aim for sort of a lower return, but lower risk. That's my preference. Yeah, so the drawdowns, exactly. So if you're aiming for 5% per week, 260% per year, you're going to have to realize that you're going to have some pretty big drawdowns when the trades don't go well, because you'll have periods where they don't go well. Nobody wins on every trade. Nobody. 90%, success rates that all these people claim. It's BS. The other factor with short-term and long-term trades is what happens with volatility. Some of you may have seen my video on contango and backwardation. If you haven't, basically what happens when we get a volatility spike, the volatility of the short-term options get impacted the most. So this is a day where volatility had a huge spike. Short-term options, the volatility went from about 13% to 33%, a huge increase. Whereas those sort of 90-day positions that I look at, it went from about 14 to 21, 22, not nearly as big an increase in percentage terms. So what is it, 33 over 13? That was about a 150% increase in volatility. Whereas here on the curve, it went from about 14 to 22. What's that line? 20, actually only 21. So 21 divided by 14, it only went up 50%. Still a big increase and still a little bit painful, but not nearly as bad as those short-term trades. Again, don't worry too much about that. It's pretty advanced, but just know that short-term trades have a lot of risk. All right, here's an example that I like to share from quite a few years ago now. But this was a 1-month bull put spread on Apple. Pretty standard sort of 15 delta, larger position size, risking 4,750 to generate 250. 1-month trade. Here's a 6-month trade. Notice that T+0 line, the purple line, is a lot flatter. See how steep that is? I kind of refer to this T+0 line as like a hill. This is a really steep hill. And this is a 1-month trade. Imagine what a 1-week trade would look like. Whereas when we look at a 6-month trade, the hill's much flatter. It's a much more gradual loss. And then I did a little comparison. Premium's pretty similar. Capital at risk is pretty similar. Return is pretty similar. But because this one's taking 6 months to get that return, the annualized return's a lot lower. But we've got a 20% decrease to our break even, whereas here we've only got an 8.5% return. If the stock is down 5%, this trade's going to lose $600. This trade's only going to lose $250. So again, that's the trade-off. Short-term trades move very quickly. They're great when they work well, but when they don't, the losses pick up really, really quickly. Yes, I do cover portfolio management, things like that, Aaron. Yes. Alrighty. So let's have a quick look before we finish up. We're getting up to about an hour. Again, let's look at, we've got Robinhood here. Let's use this one. Let's do a little comparison on short-term versus long-term. Now let's go really long-term just to make it a really extreme example. It's not necessarily a trade that I would do going all the way out 6 months, but I want to make it a very extreme comparison. Come on, IB. There we go. All right, we've got a 15 delta here. We've got a 16 delta here. It's pretty close, pretty similar deltas. All right, so first let's drill into this short-term trade. I say short-term, it's 23 DTE. It's not, a weekly trade would be even shorter term. Let's say, what's our break-even price? 109. The stock price is at 126. Let's put it the other way around. We've got a 13% decrease to our break-even. All right, this is stock price, strike price. This is our decrease to break even. And we're going to look at our T+0 line. And let's say the stock drops to 115, or let's say it's at 117. Let's say it drops to our alert point. We're going to lose about $75. This is our loss at a price of 117. Okay, so this is our short-term trade. Let's turn that off, and we're going to look at a long-term trade, very long-term. Change our expiration date here. We're so far out, we're going to have to update our range. All right, now our short strike is at 90. So let's copy this down. Strike price is at 90. We've got a 28% decrease to our break even. If the price hits 117, we're going to have to zoom in here. We're only down about $27. Much lower loss if price hits 17. Lower return, lower annualized return. Similar credit, we're still getting, we're actually getting quite a bit more credit here. Our annualized return is going to be a lot lower because it's a very slow, long-term trade. But you can see that it's much slower moving. Our actual alert point is more like 106 now. That's about our halfway point, 106, 107. So again, I'm not saying one trade's better than the other. They're just different. If you're really active, if you want to trade a lot, you want to be really active trading every week, monitoring these positions every day, you might want to do the short-term trades. You might even want to do weeklies. That's fine. Just understand the risk and understand the time commitment as well. With this trade, I can put this on pretty much leave it alone. Unless the market has a major crash, it's just going to sit there slowly decaying away. Whereas this one, it's fairly feasible that hood could drop to 117 in the next week or two, and we might have to, do some adjusting. We're going to be a little bit more active. Whereas this one, very, very low maintenance for people who are working full time, in meetings all day or whatever. They don't really take much monitoring. How many trades per week, per month? Again, when you're a beginner, you want to try and keep below about 10 positions open at any one time. Even sort of 5 to 10 to start with, and then you can start to build up. And then you want to probably limit it to about 30 once you even get more advanced, because the problem is once you have a lot of positions, if the market does crash, you've got 30 positions that you have to go in and manage and adjust. Whereas if you've only got 5 to 10, it's much quicker to do the closing trades, things like that, closing trades and adjustments. Target income for trades per week, 10% per trade on these credit spreads, and then that would be 20% on a condor. The other thing you can do is I have a goal of overall theta when we start to build out an overall portfolio. Theta versus capital account size. So here we're generating $5 a day in theta. Let's say our account size was 20,000. That divided by that, we're getting roughly this much per day in return. If we times that by 365, that's a roughly 9% return per annum. So pretty low, right? So we want to bump this theta up. We probably want that to be more like about 10%, or about 0.05% per day. So that's a little rule of thumb that you might want to implement. Again, some people who are a bit more aggressive, they might want this to be higher. They might want that 15, 20 in terms of a theta per day, depending on what annualized return you want to aim for. What tickers? Yeah, so any of the major large tickers, if we go to bar chart and we go, let's just choose this one. I'll get rid of that. If you filter this for, say, 10,000 total call volume per day, that's giving you 109 tickers. That's a good universe of stocks to choose from. So any of these top 20 to 30 are going to be the most popular, the most liquid. These are going to be the best for trading options. Then you've got your Dow stocks. So there's probably limited to sort of 100 in total that you would look at. The accelerator program, the next opening will be November, I think, mid-November. We meet every Thursday Melbourne time, so Thursday 10 a.m. or 11 a.m. depending on daylight savings, which is Wednesday evening in the US. It depends where you're based. So Thursday morning in Australia, Wednesday evening in the US. The Options Income Mastery, the next one will be opening a couple of weeks, so early to mid-October will be the next opening. Just email me if you want those bar chart screeners. That's fine. Do I use FinViz? Yes, I use FinViz as well. They have a good stock screener there also. I can send you an article if you want on how I use FinViz. But that's it for today. Like I said, we've covered a lot. I could probably do another hour class on adjustments. I could probably do another hour or two just on condors, another hour on volatility. There's only so much I can cover in 1 hour. But I hope you enjoyed it. Thanks. Thanks, guys. Thanks, Dennis. If you're on my email list, I will let you know when the course is open. Yeah. If you go to the website here, I think it shows, actually, if you go into coaching, Options Income Mastery starts October 16th. So enrollment will open pretty soon, actually. Gosh, we're almost at the end of September already. So that'll open sort of early October for enrollment. And the accelerator will open in November, I think. I haven't actually got the date on here. November 14th. That's the next enrollment period opening. Thanks, Joseph. Thanks, Kitty. Thanks, Susan. Thanks, Mustafa. Thanks, Belle. Thanks, Bert. Thanks, Ramesh. Thanks, Daryl. Gosh, we had a lot of people. People must have joined late. I think we had 45 at the start. We've got over 70 now. So really good turnout. So thank you for taking time out of your valuable day. I hope it was educational. Hope you learned a few things. I will send the replay out. So if there's any bits you want to go over again, you can watch the replay. Yeah, thanks, Enrique. Thanks, Karen. Thanks, Aaron. Thanks, Leonardo. Cool. All right, take care, everyone. If you've got any questions on anything we covered today, feel free to drop me an email, info@optionstradingiq.com. Happy to help. Yeah, any of the resources we talked about, if you're looking for any of those, ebooks, calculators, things like that, I've got loads of stuff that you can have if you like, if you don't have them already. But yeah, that's it. Look, appreciate you jumping on. I hope it was valuable for you, and reach out anytime with questions. All right, thanks, everyone. Take care.